Now, as we look forward, we're going to look at some of the key indicators that we like to talk about and just evaluate, where are things going, how are things trending. And when you look at U.S. auto sales, the slump in May auto sales, which came in at 12.68 million annualized versus the estimate of 13.7 and then 14.29 in the previous. So sales continue on that downward trend, which is just showing that, as we talked about on the University of Michigan data, where people just are a little bit more hesitant to have big purchases because prices have gone back up, but there's still that demand from in terms of what has already been spoken for. And what I mean is, when you look at manufacturing at the auto side, there's still a backlog. So there's still going to be a lot of manufacturing and production. It's just the sales are starting to wane, but there's still that backlog. So this is a bit more of a leading indicator as they try to backfill and normalize inventory. But again, a more of a leading indicator in terms of where some of that manufacturing will go. And this leads to the same thing. So the spike in mortgage rates has been driving a weaker sentiment relating to housing, with buying conditions for homes due to higher rates measured by the University of Michigan have fallen to the lowest since the 1980s. So again, when you're thinking about the pressure and the affordability of it, this is a big indicator in terms of, how much can people really start to continue to buy? And then at the same time, it also leads to, what kind of equity line can I get? Because typically, say you've been in a home for 5 years, you put down 20%, you've paid off some of your mortgage, you now have 30% equity that you could go borrow against. And what is the rate that you're going to get? But at the same time, what is the value of the home as that value starts to diminish? And then the thing is, when you're looking at how quickly are things clearing, the U.S. housing market is clearing slowly. So when you're just looking at the U.S. economic surprise index of housing and real estate, you're starting to see that slow down. Now, some will say that is more related to less supply, but we look at existing home sales and new home sales. They're both slowing. In theory, if there was a shrinking of the new home sales because of slow construction, existing home sales should be going up. But instead, they're both falling, which again there's not as much purchasing power. And yes, there's not as many homes on the market, but even those people, they're looking, but they're not actually buying, as the cost and the price is still outlandish. And then when you start talking about, back to this conversation, the bottom quintile has less excess cash than they did in 2019. So when, again, you're looking at the amount of excess cash, that is dwindling very quickly, getting worse as wages fall, and people are relying on more credit and debt. But this takes time. This is not something where people see this and instantly say, I have to change my living standards. No, people get comfortable. People like their living standards, and they will do whatever it takes to try to maintain that until forced otherwise. And this is, I think, showing that pivot and again, nailing that down. We've been talking about these issues since August of last year. So again, we thought that August retail sales were going to be strong. September was going to be weak. October was going to be strong. November, September was going to be really weak. Now, we got September wrong. September was stronger, but then you started to see that really play out, where October, November, December started to see that trend, and then it continued into 2022. And again, these are some of the pieces where, as that trend continues, the pain becomes too much, and then you get that snapping pivot, which we think really happens in during that summer months, where Q2 is going to kind of last push, and Q3 is where we see that problem. And this is one of those leaders onto why the U.S. average hourly earning is flatlining, and the rate of change for inflation is also slowing, but still going up, where the rate of change is actually flatlining, and as we showed in the previous segment, has actually turned over for a lot of different types of jobs. So that's when you start looking at the consumer board, the consumer confidence expectations, where the future expectations component has sunk relative to present situation. Going back multiple decades, the spread hasn't been at this level without a recession near or underway. So there has never been a point where we've been this low and not had a recession. So just to give you an idea on this is just indicating, again, because the recession is a little bit self-fulfilling, because the consumer being such a large component of GDP, as they slow, they become the bigger problem. So then when you start looking at another sour development, the consumer confidence index has seen a complete reversal in consumers' outlook for business conditions. So when you start looking at business better in 6 months, it's actually only 17% of people see it better. And then worse in 6 months is back to 25%. And you can see as it continues to trend up, and it's actually the highest it's been since 2020. Now, the other key piece when we start talking about inventories and some of these headwinds, so you have the consumer as the headwind, but also inventories. And if you remember what we talked about in Q4 and again in Q1, as companies rebuild inventories, that is a net positive because you're buying, you're active. That's going to be a positive contributor to a positive inventory number is going to be a strong contributor. But here, there's been a shift on the inventory side on the latest estimates. So GDP now, so the Atlanta Fed now has them subtracting 1.5% from Q2 2022 growth. So again, that's going to be that where we're going to have these headwinds when we talk more about, and when I reference the tailwinds and headwinds, this is a headwind on a calculated number, but it also points to some of the cracks starting to form on the consumer front, because there was that whiplash where companies were so short inventory, they ordered, and now they're sitting there, they have inventories, but demand is falling. So again, that's that pivot that we've seen that I think is indicative of not only an issue on the consumer, on the corporate front, but also the consumer. But we had enough through, again, that Q2 that will eke out some of that growth. So now the U.S. contribution to headline ISM, here's that supplier delivery, which is getting a bit better. New orders improved slightly, which is a net positive, but business activity is shrinking, employment shrinking, again, kind of pulling us down and bringing us closer to that flatlining number, which is, when you look at it, is comfortably within a normal range. But the problem is the trend and where we see this going as we see some of the pressure starting to mount. And that's when we start looking at these two key leading indicators: business activity back negative, moving lower again, and then the backlog of orders having a huge drop off, which again, these two key pieces is where we see these pressure points, but they're still positive. It's just when we look forward into Q3, we see a lot of reasons why this starts to go and ekes out into the negative territory on contraction, and that's where we see some of those pressure points. Prices paid, as we said, had eked out some growth. Had came in a bit stronger than expectations, but still down. And prices paid is, again, where we see things going a bit sideways and keeping that pressure on the stagflation, as manufacturing saw employment on that side in terms of going into slight negative territory, which is something that we think is going to kind of, I would say just kind of bump along sideways. As we were saying in the previous segment, slight negative, slight positive, but essentially just hanging around this 50 line. But the bigger issue when we start looking at that inventory piece, inventories continue to rebound in both manufacturing and services. So manufacturing saw more strength in May. Inventory component for ISM services ticked slightly lower, but for now remains well above 50. So again, this is what we've been talking about, where inventories are building, and as they're building, it's indicative of some of the supply chain catching up, but also again that consumer slowing down their purchases. On the ISM manufacturing side, supplier delivery times, fairly flattish. Inventories, you can see inventories was a nice little bump, which is what we were talking about. But when you start looking at new orders continuing to be that pressure, and then underlying production, again, that negative contribution, that it continues to come through. Construction spending and PPI continues to be fairly robust on the PPI side, because again, that is that driving piece, but it's also going to become a problem when you think about new construction, because the builder has a certain amount of cost locked into that building. But as things start to weaken, can they really start to see that some of that pressure? Can they recover their cost and make a profit, or are they just going to try to get out without losing money? And that's, I think, some of the key pieces in the total construction spending starting to slow as PPI goes up, with the focus remaining on residential. But as the focus remains on residential, there is a lot of construction in the supply chain. So when you look at construction, there is a significant amount of new capacity coming to market, which again is going to weigh on different things. So then on the manufacturing side, we saw prices moderate, still above 80, where input prices for the services side went to a new high. So again, what we've been looking at is, essentially manufacturing starting to see a little bit of a flatlining in inflation, where services are seeing another step up in the inflationary rate of change levels. But as that consumer, the CEO confidence moves lower, it also means, again, that shrinking CapEx. As CapEx shrinks, another headwind to the GDP side, as well as hiring, which will hurt employees again. Then when you look at the commodity price and supply pressure, still, as we've been saying, is going to remain elevated. And this is what the CEOs are seeing: more pressure, uncertainty. So sometimes, or if not at the same time, volatility creates just as much or the same or a little bit more concern versus where do we go going forward. And again, that all of these things happening together are going to force the C-suite guys to try to do less. Now, where are some of the issues coming? And one of the things that's interesting is America's biggest employers, Walmart and Amazon, are now saying that they are overstaffed. So that just, when you start looking at the unemployment rate, we expect that to start to get a bit worse, and unemployment getting a bit worse as we start to get some of these layoffs. As there was a big hiring spree because people were shopping, that people had to refill, there was supply chain issues. Now, as things normalize a bit and the consumer slows, we should see that come through. But here is an interesting thing where how families are cutting their food budgets, change the types of foods they bought, which is common. And that's the opportunity, when you look at the replacement, where, okay, I can buy an organic apple or a regular apple, or I can go to BJ's and buy a package of apples. But after that, okay, well, I can't afford apples, now it's bananas. Well, bananas being, at least by me, some of the cheapest. If you then can't afford bananas, then do you have to buy canned fruits? Then you start to see this replacement cycle until there's nowhere else to go, and then you're going to have to shift. So typically, change in the types of foods, change in the brands. Instead of buying organic, you buy name brand. Then instead of buying name brand, you buy store brand and generic. And again, going down that cycle, trying to get as cheap as possible. Now, when you start looking at the change in general on inventories versus sales, you can see that inventories has gone up extensively. And this is why we're starting to see a bit more of those discounts. But auto dealers still don't have the inventory, which is why even as sales slow on the car side, there's still that impetus to replace that still fairly steep drop in inventory. While building materials, general merchandise, furniture, electronics, all starting to see that big shift up, which is why we've heard Target and some of the other consumer discretionaries talk about how they're going to start increasing sales and discounts to try to clear some of this inventory, which will hit profits. Average daily total card spending per household, total credit, you can see that it's actually started to dip down ever so slightly. So it's important because this is looking at it in terms of total card spending. So that's just looking at the value, where so as the value has actually started to go over, but inflation has gone up, that means that the volume is actually pretty sizably down. And just given that little, you can kind of see that little turn down. You're starting to see that little, if you drew a line, there's a slight downward trajectory, which is where you're starting to see that volume fall off. Now, when we start looking at housing, pending home sales, orange is softening. Lumber prices, white, have come down as mortgage rates have gone up. So again, this is that kind of looking at it in one standpoint of things moving lower. Now, if we look at MBA, the mortgage purchase index, so it typically, as you can see, there is normally a dip for Memorial Day weekend, but you can see that we are back to levels that we haven't been at since 2015 as things slow, and the year-over-year change in National Association of Realtors Home Affordability Index is at negative 29%. Which means it's that much harder to afford a home, which is being reflected in some of the mortgage-backed data. And this looks at it a little bit differently. Housing affordability as of Q1 for first-time home buyers, it fell to the lowest since late 2008. Again, just taking more people out of that market. And then this is an interesting thing as you consider where people are moving to. The higher share of people in small and mid-sized cities are seeking remote jobs. So the smaller the city, the mid-sized cities, people are looking to work from home more. Typically, and this, if you think about it, and again, this is just going to be a sweeping generalization because some of these do have a fairly robust MTA. But as there's less transit or mass transit, there's going to be more traffic. So why wouldn't I try to work from home more and avoid some of the traffic in some of these other areas, which again is pushing people further outside the city centers, because why would I try to go in if I don't have to? So again, that you're starting to see that shift. Now, 12 million households have been priced out of a $400,000 mortgage. So I thought this was interesting when you look at the current rate at $5.09%. It means that the number of households who can qualify. So 12 million households got priced out of qualifying for a $400,000 mortgage from January at 3% rates to June 5% rates. That's a 25% reduction in potential demand as you eliminate more and more buyers, which again is a bigger problem going forward. And showing up in some of the data with home buyer demand index is now negative 9% year on year. It is now below where we were in 2020, but obviously you can see that was when we started to see that spike. Another key leading indicator is Google's people searching for homes for sale. So as people essentially say, why am I going to even bother looking? I can't afford anything. You're starting to see that come down. And as Google searches are typically a bigger leading indicator of where things are going, showing how people and the consumer's mindset is really starting to shift. Now, when we start looking at weekly showings, they did bounce for Memorial Day, but you can see that weekly showings are down versus the last 2 years. Obviously, those were big years. But as you're starting to see some of these concerns, home builders are seeing the same pain. Evercore ISI Home Builder Sales Survey is continuing to weaken. And based on the leading indicators we talked about, will take out that 2020 level. Now, the percent of properties with recent price reductions has increased to 24.1%. Obviously, still well below what is normal on price reductions, but you can see the rate of change is accelerating. And as people slow their purchasing, slow down, that is again going to increase the amount of reductions that we see. Now, this is a good and bad piece because we had the fewest immediate sales since February 23rd, but February 23rd, but there's still a decent amount of new, immediate sales. So significantly fewer new listings during the holiday week, but the fewest immediate sales. But again, you're still seeing fairly sizable sales in general. Last year, more new listings, so there was 23,286 immediate sales. This month, there was 23,002. So again, you're still seeing them, but the pace of which is slowing, and we expect to see that accelerate as well. U.S. households' value of real estate holdings versus home price index. And again, this is going to weigh on where things are going because as mortgage rates go up, taxes going up, you see this typically draw and pull things down. Again, that leading indicator we've talked about. But it's not just housing, it's also childcare. How can people afford, when you look at how parabolic childcare has gotten, for anybody that has looked at it, childcare costs have grown twice as fast as overall inflation. So if inflation has gone up 8%, it's gone up double that. And if you think about wages, where wages haven't kept pace, again, you're seeing that additional pressure to the downside on the home. And then when you start looking at U.S. employees on non-farm payrolls, retail, you can see that retail side is getting weaker. And again, all of these things are just pointing to a bigger issue on Q3, which we think is likely to arise. Now, in the next segment, we're going to go into the Europe, where we think we're already seeing problems and how we think those are going to get a bit worse.